Hi, it's Stuart Weems, and today I'd like to talk about how to buy the highest quality property within your budget. Now, of course, not all of us can afford to go out and buy mega mansions and spend millions of dollars on property, but we want to make a really smart decision. Property is expensive. It's costly to buy it because you've got to pay for stamp duty and all the other costs. It's costly to sell it because you've got to pay an agent. So the entry and exit costs are so substantial. Let's make sure that we make a really good decision, whether it's a home or investment. I think you can apply this lens to either purchases. Now, when it comes to buying property, it's all about capital growth. And I would encourage people to really think deeply about this, whether it's a home or investment property. If it's an investment property, you're buying it solely to build wealth. And regarding that, the rental income is important because it helps you with the holding costs of hanging on to that property. But it's the capital growth that will do all the heavy lifting with respect to building wealth. If it's a home, whilst we don't buy a home necessarily to build our wealth, because the capital gain will be tax-free using the main residence exemption, it can be one of our best investments. Let me explain. So if you buy, say, a $600,000 property and it grows at, say, 7%, which is kind of the long-term average median growth. Now, it's not going to do that every year, of course, but I'm talking if you hold that property for many decades, 7% growth is a reasonable number to work off. So if it does grow at 7% on a straight line basis, in 10 years, that property is going to be worth around about $1.2 million. So you've generated $600,000 of equity over that 10-year period, or say $60,000 a year. In 20 years, it's going to be worth 2.3. In 30 years, it's going to be worth $4.5 million. And in 40 years, believe it or not, it'll be worth nearly $9 million. Now, human beings find it difficult to get our heads around these sorts of figures. Like the impact of compounding just seems irrational and unbelievable. And also you might think, well, Stuart, how on earth can a $600,000 property cost nearly $9 million in 40 years? The reality is, if we look back 40 years ago, that's exactly what's happened. And if I told you 40 years ago that it would be worth $600,000 today, you would think I was crazy. Now, the point is, let's look at how that property value changes in each decade. As I said, in that first 10 years, you've accumulated about $600,000 of equity. In the second 10-year period, it's $1.1 million of equity. In the third 10-year period, so between year 20 and 30, it's over 2.2 million. And again, it doubles again in the fourth 10-year period, $4.4 million. So let's pick on that third 10-year period. So you've held the property for 20 years. What is it doing? On average, it's growing at $220,000 a year in terms of value. Now, again, some of these figures might be hard to get your head around, but the reality is if you have a look at past property growth, that's exactly what's happened. And that's why it's so important to buy well and buy a high quality asset, because if you're going to hang on to it for many decades, that's the potential upside that you're looking at. And that's what I wanted to record this video, to sort of walk you through what are the attributes that a property needs to have to be considered high quality. In my observation, there's really three criteria that a property absolutely must possess to be considered high quality. You can't have two out of the three, you need to have all three. And this is from my own personal investment experience, but also having seen literally thousands of property investment portfolios over the last 20 plus years, and seeing what works, where is the evidence. So the first one is that it needs to be in short supply. That is, that demand outstrips supply. And I'm going to talk about each of these criteria separately in a second. The next element is it needs to have a strong history of past capital growth. By trying to pick the next growth suburb or the next growth area, the problem is that you might be wrong. It just might not, despite your viewpoint and perhaps some of the indicators that it should be producing a lot of capital growth, it might not end up doing so. Or you could be too early. You could buy into that area and it doesn't do anything for 10 years, and then that's when it takes off. Whereas buying something that already has that proven performance, that ability to grow, that reduces your risk. And lastly, it needs to have a strong land value component. Land appreciates, building depreciate generally. And so that's the factor that's going to drive the growth. So let's talk about each one of these. So the first one I want to talk about is an imbalance between supply and demand, which really means supply is fixed, that there's no available vacant land in close proximity to the property that you're considering buying. So supply is fixed, but demand is strong. Demand outstrips supply. And so just notionally, what you want to do is you want to own an asset where there's at least 10 buyers, 10 potential people want to buy that asset for every available property. So you're getting into an area where demand outstrips supply. And if you're able to buy into that location, that's where you're most likely to generate or enjoy strong capital growth. And remember, we want strong capital growth over a very long period of time. Again, if we want to hold this property for 10, 20, 30 years, it's really important that we're going to enjoy a strong level of capital growth over that whole time. The problem sometimes that people make when buying property is that they look at a particular area and say, this is going to grow really strongly over the next 5 years because it's a new build area and there's more amenities coming into the area and so forth. But if it doesn't have the fundamentals to push that growth further and further over very long periods of time, it'll just level out and it'll start growing at, maybe inflation or something like that. So there's a couple of things that add to the scarcity of the asset. The first one is location. So if you're in an area like a blue chip suburb, there's no available vacant land to build on. It's the land values are very expensive. Supply is absolutely fixed. So location has a big impact. And typically as you get closer to capital cities, that's where that land is in higher demand. Right in the capital city, you've got some problems there because the land value component, if it's an apartment, for example, just isn't substantial. I'm more speaking about the outer ring suburbs. So really anywhere from 2 to maybe 12 or 14 kilometres from the CBD in most capital cities. That's where land supply is finite and in high demand typically. The other thing that's going to improve scarcity is architectural style. So if you are looking at, for example, a Victorian cottage, no one's building those types of assets anymore. That they're very attractive, to most buyers, just from a appeal perspective. And so you are buying what is a scarce asset. The amenity within the area makes a big difference as well. So if there's a very popular shopping strip close to hospitals, maybe in a great public school zone, or even close to well-regarded private schools, all these sorts of things really add to the imbalance of supply and demand, and that's what you really need. Now, let's compare that to, say, buying an apartment in a tower with 200 other apartments. You're buying a 2-bedroom apartment and the floor plan probably looks the same throughout the whole building. And in that situation, because you don't have any uniqueness with that particular property, it's whoever drops their price the lowest gets the sale. So if there's 2-bedroom apartments for sale and they're relatively similar, you're going to buy the cheapest one. So it doesn't really have that scarcity element. It doesn't have that imbalance of supply and demand. Okay, the next factor to talk about is you want proven performance, evidence of past growth. And the point of doing this is that if you're going to put hundreds of $1,000s into an asset, you want to have the highest level of confidence that that asset is going to grow. And there's a common disclaimer, particularly in financial planning, particularly with share markets, that past performance isn't indicative of future performance. However, with property, it's quite different. And the reason for that is that the value drivers in property tend to be both static and factual. So factual in terms of, how big is the land? What is the land orientation? Where is the land located? What are the amenities surrounding that area? All those sorts of things that have driven growth in the past are factual, and we can kind of point to them. They're not subjective. Whereas in the share market, it's about, what is the growth prospects for this company? Is the management really talented? Will they be able to execute on their plan and promises and so forth? All of that is a question of opinion, not a question of fact. With property, we can point to all those value drivers and they're a question of fact. The second thing is they tend to be quite static. So that is that all those value drivers that were present in the last 30 years are probably going to be present over the next 30 years, unless there's some evidence to the contrary. So, for example, the proximity towards healthcare and hospitals or good schools or established shopping strip or public transport, all those sorts of things, they don't really change. I mean, they can change. Schools can be closed down, for example. So it's not impossible, but it tends to be less likely. And because those value drivers, as I said, are factual and static, past performance can give us a lot of confidence about future performance. Now, it's not guaranteed, of course, but it's pretty strong evidence. And so what I suggest is when we're looking at a particular property, let's have a look at what it's been bought and sold for over the last, hopefully 20 to 40 years. So the longer the time period, the better the data. And then I would look at comparable properties. So if next door is a very similar property, similar land size, those sorts of things, I will have a look at what it's been bought and sold for over the last 40 years. And then go down the street and find, again, very similar properties in close proximity to the one that I'm interested in. And that'll help me build a bit of a data set. It'll build a bit of a story. Is it very compelling, like all these properties have grown strongly over a long period of time? Or is it a bit patchy? Now, you've got to be careful. Not every sale is going to reflect fair market value. There could be, reasons or situations or points in time where markets have been incredibly soft and someone had to sell because they were under pressure. So that's why you've got to build the data set. You want to make sure you've got lots of price points to look at. And then also you might need to make adjustments for improvements to the property. So if someone's made a substantial improvement to the property and as a result achieved a higher sale, you're going to need to make some adjustments for that. Now, there's a bit of subjectivity in that, but again, looking at this data is better than flying blind and hoping that if you buy this property, the growth is going to be really strong. So that proven performance is a key attribute. And the last factor of the three is a strong land value component. So the common sense is that land appreciates and building depreciate. When you build a brand new property, it's all sparkly and new, but as you live in it and as it wears and tears, of course, it doesn't look as good as a brand new property. And I guess the analogy is very similar to going and buying a new car. When they say when you drive the car off the lot, you lose 20 or 30% of its value because it kind of loses that new car shine. It's similar with property. I mean, it's not as stark as that, of course, but it's very similar with property. I mean, at some point, depreciation stops or even levels out. If you've got an asset that was built 100 years ago, it's probably not depreciating anymore. In fact, there might be some value in the actual construction of that property, and there may be the uniqueness of the architectural style. So, for example, if you had a double brick Art Deco house, for instance, they were built very well. That they've stood the test of time, and a lot of people like that architectural style, and a lot of people aren't building those sorts of properties anymore, and almost they become antiques, and perhaps the value of the building value element does appreciate. There's also, cost to reproduce, so construction costs. Construction costs have risen so much over the last number of years. And of course, that sort of helps that existing property is worth more as well. So it's possible that in situations situations, the building value of a particular asset will appreciate, but just typically it depreciates. And I should have said at the beginning, really, the overall value of the property can be split into two elements: the underlying land value and then the value of the improvements on that land, being the dwelling, of course. And so what we want to do is invest in a property or buy a property that is mostly land value. Because as I said, that's the portion that's going to appreciate. That's the scarce asset, if you like. And we want more than 50% of the overall price to be in that land value. Because if more than 50% of that, the money you pay for that asset, if you're paying 600,000, if 350,000 is the land value, then that's the bit that's going to appreciate and offset whatever depreciation might occur on the building value. What do heavy land value assets look like? Well, typically the dwelling's not going to be so fantastic. It'll be livable, it'll be tenantable, but it won't necessarily be the best house in the street. Sometimes looking at council rates notices can give us an indication of the proportion of land value. So a rates notice will have an unimproved value, which is the land, and then a market value or a rateable value. And that's the land plus improvements, if you like. And if you compare the proportions of those two valuations, sometimes that gives you a hint. But if the property is very large and it's new and it's been recently built and the land size is relatively small, that's a hint that actually you're buying a low land value property and that you're going to struggle from an investment perspective. Apartments can have an attributable land value. So, for example, if you've got an older style apartment, maybe there's 6 on the block and the block's quite large, 600 square meters or something like that. It's not uncommon. Well, that's going to be a heavy land value apartment because notionally you've got 1/6 share of that very valuable land that block of apartment sits on. Whereas if you're buying an apartment in a high-rise tower, there might be 200 apartments. Now the land, yes, it's very valuable, but you've only got a 1/200th share. And in that situation, your land value component's likely to be very small. So how do you buy the highest quality property in your budget? Well, you make as few compromises as possible. You've got to focus on these three elements, being the high land value, the scarcity, and the past evidence. Now, I think it's easy to look at past evidence, of course. The land value asset, you can buy a heavy land value asset probably in almost any location, so even a terrible one. So it's really the scarcity element that you're going to probably have to play with. And that's probably mostly related to the proximity towards to the CBD in that capital city or that town or wherever you might be buying. So as close as you can get to all those amenities, the higher quality asset. So essentially what you have to do is sort of work your way out until you can find a property that fits within your budget. And that'll give you then, okay, this is really the location I'm kind of looking at. And then what you want to do is then buy an asset that is mostly land value, more than 50% of the overall value of that property is represented in land. And then the final element is then making sure that if I do buy in this area and I do buy this heavy land value asset, that the growth is adequate. Now, the growth might not be as strong as it would be if you were in a blue chip location, of course, but you can only do what you can do. That's the compromise that you kind of need to make. But as long as the growth is adequate, so you're happy with it, then it's sort of done its job. So I really hope you've enjoyed today's presentation. If you are interested in learning more about taking an evidence-based approach towards many financial decisions, including buying property, investing in shares, investing in super, managing cash flow, all those sorts of things, I strongly recommend visit prosolution.com.au and subscribe to my weekly blog that I send out at 10:30 a.m. every Wednesday, and I will be able to share a lot more tips with you. Thanks so much for listening. I hope you've enjoyed it. Cheers.